a stable coin that has no kind of possibility to create yield and is competing against USDT, and a USDC has no chances at all. So when we look at stable coins from an investor's perspective, with a very traditional approach, so I come from composing fixed income portfolios where you usually have a rating. And you have a rating threshold, and investors tell you, I would like to have an investment grade portfolio, e.g., nothing below BBB or whatever. And I mean, on the one hand side, we see that currently there's a dominance. I, as an investment manager, of course, intend to build a diversified portfolio. So this is always and has always been my approach, to say we don't put everything in one basket. We try to diversify between underlyings, and then we define which one are the white and which one are the grey or black sheep. And this has or used to be a standard principle of the traditional markets. We have the rating agencies, and for more or less each and every security, you get some kind of a credit rating and so on. And I don't know if anybody is aware, because when we started, some of the team was saying, all right, we can always use USDC, and I said, so why? And then they said, yeah, USDC has the largest market valuation. And the question being, is it sufficient? Can we just say a stablecoin that has a huge market capitalization is by definition secure? We tend to do that, but in traditional markets we have seen that quite large organizations have failed to serve their customers. And I was positively surprised that S&P, the largest ratings agency in the world, has started to look into the different stablecoin issues. As you can see, for example, USDC has a relatively good overall stability rating of 2 on a scale from 1 to 5. So they even found some reasons to say, well, it could be better. And then there are other coins, as for example the USDE, which is a independent stablecoin, which got a 5 rating from S&P. And so that's the first part of our process. And when you look into the details of this, I can really recommend that S&P is publishing even the process and so on. And of course, I mean, when we think about, be it a large corporation, be it a bank, be it an asset manager, to put stablecoin in our portfolio, we need to have some kind of reasoning, some documentation why a certain coin is better, more stable, more reliable than the other one. And in this particular case, this kind of correlates with the market cap, USDC with 74 billion, and this USDE, which is a algorithmic stablecoin. So they kind of guarantee that their coin will always be worth $1, but not by saying we have reserves, that's the traditional approach, but by saying we have a mechanism which provides a hedging strategy, which, if it works, should result in 1 USDE being equal to one US dollar. And then I think it's a little bit simultaneous to what we see in the traditional credit markets, because if you buy a high yield bond, this is usually a bond from an issuer that has lower credit quality. And as you can see here, we have to put the yield potential, e.g. the level of return you could get out of this kind of stablecoin allocation. And the USDC is currently on Aave, which is one of the largest platforms for this kind of yield generation, between 2 and 5%, whereas for USDE, you can earn up to 20% depending on which method you use. And this is interesting when you come from the traditional market and you buy a bond of Tesla or whatever, it's kind of combined. So you have a credit rating of the issuer, and this credit rating usually determines the level of yield you can generate. When it comes to the market of stablecoins, if you want to compare it, there are two aspects of it. First of all, you buy stablecoin kind of isolation. So you don't get the yield directly from the issuer of the stablecoin. You have a second component, which is the protocol you use. And so for us, asset management firm, trying to compose a portfolio which has an attractive risk return profile, which essentially means we can't put everything in the most secure stablecoin because that gives us only 2 to 5%, and this is not attractive to investors. I mean, I want to set up a portfolio to build an offering where the investors have a relatively high level of capital return, e.g. we use secure stablecoins. On the other hand side, I do believe that we have to provide them with something higher than just US Treasury yields. So we have to get in the range of 6, 7, 8% something to be attractive for the traditional investors that see this kind of investment as a return. Collateral, and then we have the risk, and in the case of the USDE particularly, there is a counterparty risk with the specific trading venues where they do the hedging. So it's a more component. The other aspect I wanted to just share with you is, interestingly, S&P, and they have a large table of details for the process. And the rating report they publish is some 7 to 10 page paper. They don't only care about market cap and reserves, they particularly look at, for example, how distributed the holders are. And interestingly, for USDC, they figured out that the top 10 wallets hold more than 70%. So the holdings are highly concentrated, which tends to be negative, because in a scenario where a security, or in this particular case a stablecoin, is rated for its security, you don't want this kind of concentration. So even the USDC is not kind of ideal, even though there are more than 3 million wallets using it. And I think this is pretty interesting, how a traditional rating agency more and more tries to adapt the traditional risk metrics on some of these new kids on the blocks on a stablecoin. And then DPEX, I don't want to go too deep into the details. The redemption mechanism, so how does it work exactly? Is there a counterparty risk within the entire system? Is the collateral transparent? For example, USDC is doing monthly audits to meet, to some extent, the regulatory requirements, but to some extent, and that's interesting as well, many stablecoins define their own criteria. So they don't just say we meet the kind of requirements under the whatever act. We have our own standards. We do some kind of self-regulation, which I find interesting, particularly in an area where for quite some time, in many jurisdictions, there is no official law on who and why and what you need to do to issue a stablecoin. And then the companies start to kind of be on their own to define their standards. So the first step is, and we are currently in the process of working that out, on defining thresholds, saying our portfolio will have up to 30% in each of the larger, well-rated stablecoins. And then we try to figure out if we do smaller allocations in the kind of B-rated, the non-investment grade stablecoins, because they provide a higher yield. And we do simulations on that to eventually build a robust portfolio. The second part, which is not easy because there is no standards. And we have heard a lot about DeFi, we have heard a lot out there on lending and yield generating protocols, mostly from either individuals doing it or from organizations doing it on their own account. I haven't seen so many institutions, there might be a few in the US, that invest other people's money, that act as asset managers and employ this kind of yield generating protocols. And here are some of the protocols we are currently looking into. Aave, I believe, so that if I just may ask you a quick hands up, who has deployed money in Aave? That's by himself. Okay, it's quite some. For me, the question is, so when I invest my own money, I like to just play around a little bit. I know that there is a risk associated. I do hope that the return compensates for the risk. If I do it in a professional environment, as an asset manager with other people's money, I have to define certain processes. And the interesting thing is that if I talk to my regulator, they have no standards. They say, okay, if you make investments into this area, of course you have to ensure that you define the universe and that you clearly have a structure and a mechanism and a process defined how you pick the coins you want to allocate and those that are not eligible. And secondly, we recommend that you just don't try to pick whatever is on the market that generates a high return, but you have a process to define which one are the reliable protocols and which one are the ones that are less reliable, that either get a small allocation or just kept out. And then, of course, we have been thinking about the different ways of allocating money. So, of course, there are a bunch of DeFi protocols. We are currently in the process of testing all this in a kind of professional setup. We do use Aave, we do use Morpho. We are experimenting, to be quite frank, with protocols like Fungi, where you allocate stablecoins and then, usually AI-based process automatically allocates your funds into the most attractive protocols. Again, the question being from a asset management point of view, can I just give my clients, my investors money into an AI protocols that then chooses the right way of generating yield? And we always have the issue that it's essentially a smart contract, and we look to interact with protocols that provide smart contract audits, which is a necessity. However, even for these, there are no standards yet. And then, of course, the activity of the underlying strategy. So, do we want to allocate money with a kind of 3 months period, or do we need to invest into protocols that do a daily or even 24/7 automated reallocation depending on maximizing the yield? And these are mainly the aspects we are thinking about. I don't know if Fungi is something that you have heard about. It's a company we invested in because we like their project. Now we need to decide if we are willing to give our money or our investors' money into this protocol, even we like the team, and we need to define how the due diligence is going to work on that. And in many cases, it's a due diligence on a smart contract because there are no individuals and there is little paper to check. So this is one detailed transaction. But how fungi, for example, works, it determines the highest yielding protocol and does a reallocation, in this particular case, on a daily basis, which is quite cool to see. Does it meet investors' appetite, or is it too much? Do we do a small allocation into that, or whatever? And this is essentially the kind of problems we are currently facing. How to set up a product that ultimately is something where a pension fund might be willing to invest in, driven by the idea of, first of all, doing something innovative, which for it alone is not sufficient, driven by the idea of having a relatively low risk and having a return somewhere in the 8 to 10 percentage bracket. And yeah, that's essentially what I wanted to share with you. And I would be curious to hear from the audience, particularly from these that are already themselves investing into DeFi protocols. So how do you handle the risk? Is there a high appetite for risk? Do you have to accept risk? And how can you define risk in terms of these things? Or any questions from your side?
Yes, sorry, I have a rather naive question to
Yes.
start first. But okay, you hold stable coins.
Yeah.
You put them to work into a protocol, and that's what's create the yield.
Yeah.
But can you elaborate on that, just for?
It's a broad range. So the easiest way to generate yield is the traditional staking, e.g. we employ the stable coins in its own protocol and we use it as a contributor to the system running and we get rewards out of the protocol. This is something that works on Ethereum, for example. We have done it with Ethereum on our own for quite a while. We run our own validator, so we are not dependent on kind of external providers. We have no counterparty risk. That's something which is it standard? I think it's more or less something many professional investors into crypto do. And then you can provide it into lending protocols, for example. So you would not lend directly to an individual these stable coins, but you would just provide them on a platform that then provides these stable coins to someone else in a collateralized way and earns some interest on it. And you, as a provider of these stable coins, get a significant part of that interest income. And then there are other things. So many of the digital exchanges, DEXs, or decentralized exchanges, in order to work, they need to have liquidity. They need to be able to fulfill orders that come into their smart contract. And in order to do that, they lend coins. Usually they do it by lending a pair of coins, and then they return after whatever, and the lender gets a part of the trading fees and the commission the platform or the venue is generating. This is another method of yield generation via smart contracts, where you sometimes use stable coins, sometimes you can do it with non-stable, e.g. with volatile coins. Was my answer correct, or any other aspects? Any experience with yield farming? Yeah.
I mean, how do you explain to your investors that the yields, for example, on some of the more solid stable coins are relatively low compared to what a US Treasury bill would pay? I mean, you had on your slides 2 to 5%, US Treasury somewhere in the region of 4%. You've mentioned a potential counterparty risk, if you want to call it that way, if stablecoins are land on. So how do investors, what are the answers you're getting, in that discussion around risk and reward, which to me seems almost a bit unclear for some of the more liquid stablecoins at the moment?
Yes, of course. I mean, if I just say, give me your money, I'll convert it into USDC, and then I'll put it into Aave, and I get 3% out of it, and I take a management fee of 0.5%, and then you get 2.5%. I'm unlikely to get investors into that. So what we intend to do is to build a diversified portfolio, which may include some 20% USDC or 30%. I think part of it might go into Aave because this is the kind of the safe part of it, and like building a diversified fixed income portfolio where I have maybe some 10% allocation on bonds or treasuries, and then I do some higher yielding things with a 5% allocation. The idea is to build a portfolio that ultimately gives some 7, 8, 9% yield, significantly above treasuries, with hopefully a similar risk profile. However, comparing the risk is pretty difficult because you can't just look into the credit worthiness. I do believe that from a pure credit worthiness point of view, a stablecoin portfolio is likely to be similar to a investment-grade fixed income portfolio. However, of course, there are other risks associated to that. That is the smart contract risk and so on, which is pretty hard to translate or to compare with the risk. And this risk needs to be rewarded by maybe twice in turn you would have on a treasury portfolio. That's the. I mean, the product is not yet existing. We're talking to potential seed investors about this. I like the idea to develop something which is digital assets, which is crypto, but which has a significantly lower volatility because there's hardly any price risk, and that gives you an interesting yield. So that's how I have it. Other questions, remarks?
Based on what you just said, I'm still, wondering how this. For instance, I understand that it is crypto, so it's not going through normal deposits in banks. But how, from a yield and on a risk-reward perspective, how does it compare to investing into corporate bonds, government bonds, and private credit, for instance? What is the difference? Is there a higher yield? Is it a lower yield? And what is the reason for that difference, if any?
Yes. I mean, look at maybe a very, very easy example. PayPal has issued a stablecoin recently because they want to experiment in this sector. And in the first, I think, 6 months after launching this stablecoins, they were offering a return rate for everybody buying the stablecoin and holding the stablecoin and staking it. So not giving it back, but putting it into an account, so to say. And that initially was about 25% return, significantly higher than the yield you get on a PayPal bond. So to some extent, I mean, it's the same risk. It's the kind of credit worthiness of PayPal, which is quite high. I think the technical part of a PayPal-powered stablecoin is relatively small compared to whatever other markets. And at that point in time, it was 10 to 20% yield. Because it's new, because there are players in the market that want to get access to that, so they pay a premium. And then, secondly, I think this market gives an opportunity for generating higher yields. Look into this atomic swaps and credits. So you can get credit from one of these platforms, not for a day, but for half an hour, for example. The interest rates are interesting, and for the platform, the advantage is that you have the opportunity to have 10 or 15 or even 20 times a loan per day, which then accumulates. So I think the aspect of global availability, instant settlements at low or zero cost, is something that over time will definitely, and we manage funds in private credit as well, and we see more and more, not so much in Europe, but in the developing countries, that there is an interest to get private loans in the format of a stablecoin, because it's much easier to don't have the charges of a bank, and usually all these loans that are traded on a platform are collateralized. So they do have one coin that's given into custody, and then they get money in another coin, and therefore it's theoretically 100% secure because it's fully collateralized. So the risk should be lower, and the return due to these aspects is somehow higher. Yes.
I would have a question, but more around regulations. So, for anything that is really DeFi-related activities, you do have some regulatory uncertainties, and I'm curious to know, like, how do you balance that? How do you make sure that you meet your compliance and regulatory requirements when you say, okay, we are going to invest in a DeFi protocol? Looking at whether or not it's fully decentralized. Is it truly really decentralized? Is there really anyone that we cannot reach out to? Like what do you do in practice? Like what is your
So frankly, there's little regulation on DeFi. So even MiCA, the European regulation, has hardly any rules on it. And so we are a different animal because we don't fall under MiCA because we are not a provider of crypto asset services. We are traditional asset manager. We hold a license to be our own administrator, and currently our regulator has no rules at all.
Mm-hmm.
I personally, because I like freedom, interpreted that we have no restrictions on what we are permitted to do. We had some correspondence with the German BaFin, so for some time they were telling us that they would feel it appropriate that we don't do self-custody, for example, because we are a registered fund. And they said, yeah, as a registered fund, you should not do self-custody, and we talked a little bit with them. And then ultimately they came to the conclusion that there's no reason for them to not permit it. And as you may know, if you want to play these DeFi protocols, you have to do the self-custody, you have to interact with the DEXs or the venues directly. And when you use one of these custody providers, in many cases they're extremely restricted in what they can offer. And still the pricing is extremely high. So we have been in discussions with Tangany. Tangany is a Munich-based, one of the first regulated crypto custodies in Europe. And they, at some point in time, were open to provide us with a solution that our crypto that was in their custody could be used in a staking protocol. And they were asking for 25% fees on our rewards, from which is kind of doesn't fit them if we do it on our own. So we run our own validator now to do it. And until now, the regulator, we openly communicate with them. We know that there are some other places in the German market where the regulator is a little bit more restrictive, but still it works. And I personally like to just discover the boundaries of what we can do, because I strongly believe that this is the future of financial markets.